Let's start with those Powell comments. No hurry to cut rates. What does that mean, do you think, to markets for December and for 2025?
I think it's putting a bit of doubt that the 25 basis points cut will be delivered in December, which was almost fully expected before those comments, and that's why it had a bit of a reaction. I think this is kind of reasonable. Inflation has clearly shown that it's a little bit sticky, and obviously they're worried about the inflationary policies that might be from the incoming administration. And then now we've got to wonder about what's happening in the jobs market. There's been signs of weakness, but I have to say, initial claims yesterday again lower, which, I really think puts a lot of pressure on the jobs print before the next Fed meeting. That will probably really decide whether we get that 25 basis points or not. Overall, though, I am still in the camp that the Fed will struggle to cut as much as is still priced, even though we've rode back in some of those bets. It'll still struggle to cut as much as priced unless there's a sudden crisis in the economy.
So is the bond market at the moment underpricing that risk? How quickly could we accelerate to the upside on yields?
Look, it really depends what gets delivered in the policies in the administration. There's a lot being talked about. I think there's a real risk, given that some of the things be considered, that yields could go a lot higher next year. But I think it's right for bond markets to not rush to that conclusion. So, no, they're not underpricing it right now. I think actually one of the conclusions might be that bond markets might bounce around in a range at the moment until we get more clarity what might be delivered, because there is so much uncertainty, and really it could be quite binary in either direction next year. I don't think the long end base for yields is as low as some people were hoping. We're not going back to the pre-pandemic era. I think we've got more normalized markets. So I think that the tail risks are on both sides, but I think they're much bigger for higher yields. But really at the moment there's not much certainty. We probably have to wait to the new year to get really exciting movement in the bond market again.
Mark, 444 on the U.S. 10-year this morning. How high does it go? What's the ceiling?
Again, it depends on what policy is delivered. I think the idea that we talk about 5% of some binary level is ridiculous. I can very easily see a world under some of the policies that we discussed where 10-year yields go much higher next year. I don't think that 5% is some stopping point. But I also see a world where they go back below 4%. So I really kind of think that 10-year yields are going to be stuck in this kind of range for a while until we get more clarity what's going to come through from the new administration. What does that range look like? I don't know. On the spot, making it up here, I'm saying roughly kind of 420, 470, 430, 470, that kind of thing, that range. I think there's going to be really big move in bonds next year, but I think trying to preempt it before we have clarity on policies doesn't make much sense. And I think there'll be a little bit more excitement in the front end because we do have that uncertainty whether there will be the cut in December and what comes after that. So I think actually more of the excitement will come in the front end until next year, and then next year it'll all be about the long end trade.